Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome in to the weekend edition of the KE Report. And this weekend show, we're going to be again focusing on the resource sector, all for you investors out there trying to filter through what some of the best stories are, some of the most significant news, and quite frankly, just how strong this bull market could continue on for lifting all stocks. But again, you do need to be still somewhat selective in this market because some stocks are definitely outperforming the wide range of resource stocks out there. In the first half of the show, we are chatting with Matt Geiger, managing partner at MJG Capital. Matt, as we always do, we like to start off by just getting an update from you in terms of any changes in your portfolio, in your overall strategy at MJG, being focused on resource stocks, since we have seen silver breakout. Gold also recently, intraday, touch day, all-time high. Copper, it's off its highs, but it's still right around that $5 level. So Matt, from a portfolio management standpoint, any big changes we should be aware of at MJG?
Good to join you again, Corey and Chad. And yeah, a lot has changed on the market side of things since we last touched base in mid-April. But on the portfolio front, really nothing too dramatic to report. Just as we were and have been all year at this point, we are fully deployed, so very minimal cash position at this point. And I will say very pleased with the performance that we've seen starting in March with gold's breakout in early March, right around the PDAC conference, really going through May. So hopefully that continues, knock on wood. Yeah, on the portfolio front, we still remain heavily weighted towards copper, getting closer now to a 40% weighting within the portfolio. So this is by far the highest weighting towards that metal that we've had really since the fund's inception. Part of that has been driven by some outperformance amongst our copper names. Lara is one example in terms of a name that I've written about many times previously in MJG partnership letters. We actually also just got an allocation last week to a highly sought after placement that is copper focused. I'm really not in a position to talk about that one publicly at this point, but hopefully some point I will be here. But that takes our copper position just that much higher. Otherwise, we're winding down a smallish position, one that I haven't discussed publicly, and then averaging into a couple other existing holdings. And then other than that, we did actually at the end of April, since we last talked, participated in a financing of an existing holding of ours. And this is actually the third different financing we've done with this group, which is a Nevada-focused exploration story with excellent management, in my opinion. And yeah, aside from this new copper placement that I just mentioned, I think that will be our only new name that comes into the portfolio in Q2. So I'm largely sitting tight, doing some things on the margin, and trying my best to beat off feelings of FOMO that I think we all feel in these exciting times, of just trying to stick to the plan and keep the portfolio nice and concentrated with names that I know and have conviction in.
Well, Matt, just to that point, when you get positioned in your portfolio, you generally look at the company first, the opportunity, the management team, the project, and all of the specifics. And only at the very latter part of that filtering process do you even consider the metal of focus. But as you say, you do have a pretty big weighting to copper in the MJG portfolio. So let's maybe talk about copper. We just saw some big news out where the hedge fund manager, Pierre Andurand, expects possibly a quadrupling of copper. There was all these articles that came out last week where he's talking about 40,000 a ton. We've been talking about 10 to 11,000 a ton lately, and 40,000 a ton would be a 4x move in copper. In that kind of a backdrop, even if that's maybe slightly aggressive, do you consider that to be something that factors in now that you have such a big weighting in copper in your own portfolio?
Yeah, that did make some headlines, didn't it? I got a number of texts actually from generalist friends that saw that. I think that article was featured in the that quote was featured in the Financial Times originally and then made the rounds to mainstream publications. Look, I should first say I'm naturally skeptical, honestly, of anyone making these pie-in-the-sky metal price forecasts. I'd argue it's largely poor form. And even though it can make for good headlines, investors in the junior space are better suited to really tune out these prognostications and as you note, I really urge focusing on company-specific factors, the people involved, the company structure, whether the project works at spot metal prices, yes, spot metal prices, pending catalysts, and then also the current valuation of the company relative to what the investors' projected fair value is for the company. And so I think it's very important to tune out the metal of focus as much as you can from your investment process, which I know to folks new to the space may seem counterintuitive, but it's very easy to get caught up in flavor of the month type stories where they're chasing the hot metal. And unless there's real substance or quality to the company, those stories usually end in tears. So I've really made my living investing, focusing on companies where value can be created, even if metal prices were to stay flat in perpetuity. So I think that is the way to think about it. And for the vast majority of investors, I think that's the way to go. Now, to Andrean's claim of $40,000 copper, which is equivalent to just over $18 per pound. I usually think of copper from a per pound perspective personally. Is it entirely outside of the realm of possibility? Even though I think it's irresponsible to be saying such things, I would argue it's not totally outside of possibility. All one really needs to do is look towards the past. And in copper's last great bull market, this would have been between late 2000 through early 2011. We saw copper rally from 60 cents in late 2001 to a high of $4.60 in early 2011. So that's a move of 7.5x magnitude. So extremely significant move. Now noted, it did take a full decade to play out. So for the sake of comparison, let's just assume that history exactly rhymes in this case, which I think is not a fair assumption, but we can just take that at face value. This current copper move started from a base of $2 per pound in the depths of the COVID panic in early 20. We traded down slightly below $2 per pound, but we'll say $2 per pound for this exercise. So if one were to see this 7.5x move in the copper price from the trough to the peak, we would be looking at a copper price at just over $15 per pound. So while this is a little bit short of Andrean's bold prediction, it's in the rough ballpark. So I think what he's saying is possible. It's not totally inconceivable. But even still, I think investors would be better served assuming flat copper prices from here on out and focus on stories, focus on people where you believe value can be created, even if the copper price didn't move a single cent from its current perch at $4.80 per pound. I really feel firmly that's the way to go.
So, Matt, what do you think about all these copper companies out there that do have large assets in the ground around the world that are pretty much shovel ready? They just need maybe permits, but a lot of them simply just need the capital to get them going. How do you balance out an investment narrative on those, but then filtering down to, I know you like exploration plays, people out there trying to make new discoveries, potentially higher grade discoveries. It's one of the hits against some of these large projects is that they don't carry the high grade that some of the new exploration, more exciting plays can. How do you balance out those two investment narratives?
Yeah, that's a fair point. So I think the first type of story you're referring to would be these late stage developers where the deposit's largely defined already. We know roughly how big it is and at what grade. And the question is, can it be built? Will it be built? And are you paying a fair price for it at its current stage? So I think all of those things need to be looked at one by one. And some of these projects look great on paper and would make a lot of money as a mine, but either for social or environmental reasons won't be built or are very unlikely to be built. So I think that's a key point to focus on for these types of late stage copper development plays. Then you want to look at the timing. Some of these may be built later this decade or early next, but it's unrealistic to expect any movement in the near term. So if you're making an investment in that type of story, the only catalyst that you can hope for, other than a doubling in the copper price, which would admittedly help the share price, would be a takeover offer from a larger party that then wants to build the project. So those types of stories can be a bit devoid of clear share price catalysts. And you're waiting around for either the copper price to work in your favor or for a larger party to come in and take them out. And then you need to look at the price being paid. So that's why I'm hesitant to say I'm all in or I'm all out on these types of stories. They should be discounted relative to both the amount of risk in terms of receiving permits and the social license to go ahead, and also discounted on how long, even if everything goes perfectly to plan, one could expect before shovels could actually go into the ground and the project could presumably be built. So I think for a very rough rule of thumb, for a feasibility stage project that looks good on paper, makes sense at $4.50, $4 copper, you maybe want to discount that 70% from what the after-tax NPV is, assuming a reasonable discount rate. And if you look at that project and you think it's going to go ahead at some point here, but it's trading at 0.3 NAV, then it's fairly priced. Again, these are very like broad stroke numbers. But if you're seeing it and it's at 0.1 NAV, and you look and you can't see any critical flaws on the permitting or social side of things, then maybe that could be of interest. So I think it has to be looked at case by case within context, but I think those are the key headlines to look at. I should say, interestingly, the vast majority of our copper exposure does not come from these later stage development projects. I don't think that's a bad way to get exposure to copper, mind you, but the majority of our copper exposure comes from either royalty names, prospect generators. I mentioned Lara earlier. Lara's a bit of a hybrid at this point. They're interesting in that they have a 100% owned later stage copper asset called Planalto, and then a kind of prospect generation portfolio to the side of that also has significant copper exposure. So they're a bit of a hybrid there. But royalty, prospect generation, and then exploration names are primarily where our copper exposure comes from. That said, that new placement that we just put our hands up for last week, that does fall into the later stage pounds in the ground story, where hopefully, if all goes to plan, it could be developed later this decade or early next. It's a bit of a mix.
Well, Matt, just a quick follow-up on that. When you think about the landscape of copper mines that actually get built and actually contribute to the copper supply that the world so desperately needs, most of them are large bulk tonnage projects. So some of those late-stage developers that are sitting there with their hand up saying, hey, take me over so we can build this project or partner with me, those are really the ones that, even if they're still drilling on them, are the ones that are likely to get built and actually be contributors. There's not that many high-grade underground copper mines that really make it into production. In the exploration world, there are a lot of investors that get excited about the high-grade copper hits, but the reality is very few of those actually tie together into a deposit that's going to work on an economic basis and be a real copper mine. The big projects that have the low bulk tonnage numbers don't excite retail investors, and yet those are the ones that usually move forward. So how would you parse that out as far as investors looking at the space? Because everybody gets excited about high-grade underground in Australia or in Canada or even in the US, but the reality is it's the bulk tonnage projects that get built most of the time.
You're right. I mean, yeah, the big boys of the copper production world, at this point, they're almost exclusively focused on porphyries. I guess some sedimentary deposits as well, if they're large enough, could fit within the mandate. But the world's largest miners are just not interested in VMS or narrow vein, even if it's extremely high grade copper, underground copper deposit. It just doesn't move the needle for them. So that doesn't mean that value can't be created throughout the different ecosystem of copper style deposits. But if you want to sell to the biggest companies in the world, you should be looking at a porphyry, plain and simple there. And yeah, to your credit for those, or to your point, to those later stage stories, you're really not going to move the needle with drill results. So I think to maximize value for shareholders, the exercise needs to be to first limit dilution to the absolute utmost extent possible to preserve value for when that takeover does occur, hopefully later in the cycle if it's well timed, and also to push as far forward as you can on the permitting and social licensing activities that are needed to get the project to a true shovel-ready status. And while that blocking and tackling on the social and environmental front is not sexy, is not going to move the market with a single news release, that's the stuff that really adds value, at least in the eyes of a potential acquirer. While the market might not value it, it at least gets the project closer to a point where one of these big boys are willing to step in and actually build the project. But the copper market's just so big at this point. Like, this is not lithium. Some of these projects, even for the world's largest miners, you'll see them, well, firstly, they don't have the technical expertise in-house anymore to be focused on more than one mega project at any given time. So I think that's actually bullish for copper longer term, at least on the supply side, where even given infinite money, there's just not enough folks with the know-how within these big companies to be building 2 or 3 different projects at once. If that occurred, that's a thing of the past. And you're even seeing some of the world's largest companies prefer to partner up on assets and do a 50-50 JV with a similarly sized peer, both to share the financial and technical burdens together. So yeah, I just don't think you can understate how big, complex, and risky building some of these new projects from scratch are. And yeah, the big boys do not feel comfortable focused on more than one at a time. So yeah, that's why I think it's hard to imagine a flood of copper supply coming online anytime in the near future. And we'll probably lengthen out the run of this bull market, one would hope.
Yeah, good point there, Matt. Look, these mines are hard to build and they take a lot of capital, a lot of time, and a lot of talent. And look, we haven't had a ton of talent coming into this sector. So, yeah, these guys do need to focus on individual projects almost one at a time. And as you said, partner up on them to share some of those capital costs. Let's talk about a stock, though, that got some attention this week. One that you've brought up on the show before, being Bravo Mining. A drill result, a new discovery on Tuesday, May 28th, moved the stock about 40%. It's again, new discovery. The company has this Luanga deposit that was driving the story. That's a PGM deposit, but this new discovery, it's a bit more copper focused. We saw some high-grade copper. We actually saw some high grades in terms of other metals as well within that result, but it is maybe one of the biggest news releases of the week. Let's start off with what caught your eye on this new discovery, this copper hit.
Well, sure. I should say up front, we're highly conflicted on this one. The MJG partnership has been Bravo shareholders since early 2022 when the company was private. And I'm happy to say it's our largest single position within the fund. So very biased when it comes to Bravo. But look, this news release was a game changer for the Luanga project. It's not every day that one stumbles on a blind discovery of 11.5 meters at 14% copper with a healthy kicker of 3 grams per ton gold. And the company also estimates that this intercept is 100% true width, which is important as well. It is undercover, but it's starting at 165 meters. So in the scheme of things, that's not particularly deep at all. But one should look at this through an underground lens at this very early stage. And yeah, I should caution that it is very early days. The discovery announced today is at what they call their T5 target. And it's only the second drill hole ever drilled at the target by anyone. Bravo drilled one hole earlier this year that just clipped the edge of the mineralization, and they got a short intercept of 2% copper and were encouraged. So they came back in and drilled this discovery hole with a slightly different orientation, and voila, major discovery announced. So they've now completed a hole 50 meters to the east of the discovery hole announced this morning. And in the news release, they mentioned that assays are still pending, but they did hit 9 meters of similar looking rock. So the market's eyes will then turn to assays from this hole, which I'd imagine will be out in the next 4 weeks, if not sooner, to see if the grade is similar to the step out to the east. And then they also have a hole in progress, which is a 50-meter step out to the west. So I think we will probably see assays from that hole, we'll say, in the next 60 days or so. So those are the immediate things to look for in terms of this discovery. But taking a step backwards, and to your point, Bravo has not been focused on copper mineralization. This is a really interesting case of the sometimes beautiful serendipity that you can see within mineral exploration. There are a lot of surprises in this business. Most of the time they're ugly surprises, but ever so often there can be a positive surprise. And I think this is a prime example of that. Bravo was focused, well, they have a 10 million ounce Luanga deposit, which comes to surface and it's hosted in layered and mafic and ultramafic complex. And these types of deposits often have a feeder zone. Some folks, somewhat promotionally, will refer to these as Norilsk-style feeder zones. So the real purpose of the exploration program that yielded this discovery hole was to test 11 different EM targets over the footprint of the Luanga project, looking for this mafic intrusive zone that yielded this broad but lower grade deposit at surface. And this was one of the EM targets that they tested, looking for the feeder zone. And lo and behold, they did not find the feeder zone, but instead what they found is previously unknown IOCG mineralization on the project. So this type of mineralization seen elsewhere in the Carajás district. So it's certainly not a surprise from that perspective. This is not what investors and probably management were expecting to see whatsoever. But yeah, they've stumbled into a new style of mineralization. And it says right there in the news release, it seems quite unlikely that it's related to Luongo whatsoever. So it's looking like a second discovery of a different style of mineralization that just happens to be on the same project footprint. So in some ways, you could call this an accidental discovery, but I don't want to take credit away from the management team. A huge amount of geological work went into this exploration program, and obviously they weren't drilling blindly and taking pot shots. This was a curated target amongst 11 that they've highlighted as top priority that had significant EM anomalism, but it just yielded a different style of mineralization than what they were drilling for. So it's really exciting. It's a great story, I think.
Well, Matt, this is an interesting story in the sense that a lot of times when companies are testing an EM anomaly, they know there's something there from a chargeability standpoint, but they're not sure exactly what. They poke a hole under the ground. And a lot of times, like you say, the surprises in the industry are a negative surprise. This was a positive surprise, maybe a completely different kind of mineralization, but it reminds me so much of the Hercules silver phenomenon from last year, where they're exploring a silver deposit. They have an EM anomaly. They decide to drill a hole at depth to see what's going on. And then they make this big copper discovery, and in come a whole lot of new investors that maybe weren't as interested in the silver, but now they're suddenly, amped up about the high grade copper. Well, we're seeing the same kind of thing here, where is it possible that something like this for a company like Bravo brings in a different kind of investor? Maybe they weren't animated by PGMs and nickel, but they are animated by copper. Maybe just to talk about those dynamics of how the investor base can change based on discovery.
Yeah, I think from a very high level, that comparison is apt. Obviously, in the case of Hercules, they had some interesting looking silver mineralization closer to surface, and they fortuitously decided to take a bit of a shot on a deeper EM target to see what was happening there. And lo and behold, they've stumbled upon a major porphyry discovery, and I think that district will yield multiple porphyry centers. I am a believer in the Hercules story, at least longer term, and I understand why Barrick pulled out all the stops to get involved with that story. Yeah, in the case of Bravo, I agree with you. Look, I think the existing Luongo deposit can become a mine. We wouldn't have been shareholders of the story otherwise. So I really like the management team here. The company structure is pristine. They're very well cashed up with their existing plans, and I imagine today's news release and results will likely alter their plans for 2024. We might see them put their foot on the pedal a little bit more aggressively here. But even with a full work program across the project, including metallurgy, 60,000 meters of infill and resource delineation drilling for Luongo, and this higher risk budget of 3,000 meters over 11 targets, they were still expecting to end 2024 with $20 million in the bank. So again, I think we could see them go more aggressively, but the point stands that I was in Bravo for the people, company structure, well cashed up, and I think the Luongo deposit in its own right can very well become a mine. But yes, just look at 2023. If there were two different metals that you would not want to be exposed to, it would be nickel and palladium. And I think it's been a mistake. But I think a lot of investors have looked at Bravo, appreciated the people involved, appreciated the geological potential, appreciated the scale of deposit, but it's just been turned off by the metals of interest. So for those folks, the fact that there's now a distinct copper flair to the story, I think it's going to drive new eyeballs. And we can already tell from the market reaction that it has as the company's up 50% or so on the back of these drill results on heavy volume. So yes, if you could choose a metal to have some exciting exposure to in today's day and age, it would be copper. So I think that does augur to the company's benefit. But I think it's also an incident or an example of why you want to tune out the metals of focus and not get too caught up, because I do believe that there are investors out there that took a look at Bravo and were frankly turned off by the metal mix of Luongo. And I think in hindsight, that will have proven to be a mistake.
So Matt, what drives this story moving forward? Because that maiden resource estimate came in just under 10 million ounces palladium equivalent. So there is the asset there. Like you said, that's why you got in. But now there's this copper angle that the market started to take note of. But the market was taking note of this story last year, in the first half of the year at least. What are the key catalysts you see here as an investor that could keep this momentum going to the upside?
Yeah, there's a lot here. In the immediate term, it's going to be all about the copper. So that is going to drive the share price for the near term. It's maybe even to medium term. We'll see how significant it is. It's still very early days, as mentioned. but we'll know shortly here whether the 50-meter step out to the east yields similar grades to the drill hole discovery announced this morning. And then subsequently, we'll learn whether the mineralization extends to the west as well. And look, these are superb grades by any standard, and 11.5 meters, 9 meters, like those are nice. Hypothetically, those are nice mineable widths. So from my perspective, this is more of a question of tonnage, how big this is, and do the grades stay in that kind of stratospheric level that we saw this morning? Those are all unanswered questions to be answered here by the company. And then while that's going on, they'll still presumably be testing the remainder of these EM targets. And now it begs the question whether some of these EM targets may be IOCG related versus the feeder zone that they were originally drilling for. So they're going to be testing these other targets as well. Could come up dry, many of them will. They may ultimately stumble upon the feeder, which would be a massive prize. The probabilities are low, but that's still in play. Or they may stumble into additional IOCG mineralization from some of the other targets. So that's a secondary thing to keep an eye on. And then, as you mentioned, behind the scenes, it's a little less sexy now, but they're still pushing full steam ahead with the Luanga deposit itself. And we should see an updated resource by the end of the year here, hopefully with a significant increase to resources, well over 10 million ounces of palladium equivalent. And I think we'll see our first economic study later in 2025. So we'll see if that corresponds with more attractive PGM and or nickel pricing. So a lot going on, but I think, this discovery blows open the doors in terms of near-term catalysts for the story. And their next 2 or 3 news releases here are going to be very closely watched.
Oh, I bet they are. Following up on discovery holes, always key for investors. We know how much volatility can happen around there, and even more importantly, the potential upside if they keep on hitting some of this high-grade material. Matt, very interesting. Thank you very much for your comments and some insights in what you're doing within the fund that you run. Always appreciate hearing, again, your moves and that more focus towards copper. Boy, oh boy, it's been in the news, and the stocks have, at least some of them, started to run here. It's encouraging to see for investors in this space after 4 years of a tough market. We're truly seeing a turn, and we're only about 3 months into it right now. Matt, have a great rest of your weekend. If you want to follow along and see a bit more in terms of what Matt is doing within his fund, check out that MJG Capital website, which I will post to below. Thanks for your time, Matt. Have a great weekend.
Thanks, you as well. We'll talk soon, gentlemen.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report. We're now shifting guests over to Axel Merk, President and Chief Investment Officer of Merk Investments. Now, Axel, I wanted to start off with a general question on gold ETFs, the balance, inflows versus outflows, even as the gold price has moved higher and held up at these all-time high levels. One thing that I've been hearing is that some gold ETFs are still facing outflows. So it doesn't seem like that Western demand is coming into the market. What have you seen? Your insights on gold ETFs, the balance between inflows and outflows, please.
Yes, great to be with you. And I'm sharing a visual here that comes across super good on any audio. I'm looking at the chart of the US gold exchange traded products year to date. And the one with the biggest inflows has about 8% in inflows is actually the one that we manage ourselves, the Vanek Gold Trust. And then there at the bottom end, there's one that had a little over 5% in outflows. There were outflows in most of the products until a few weeks ago. And then there was something like 5 days in a row where net the industry had inflows. And some people proclaimed a new trend in recent days. That record was broken, not in a good way. We've had some outflows again. And so it's been a bit more mixed. Overall, we've seen a lot of buying on the physical side, but in the gold ETF side, it has been far more reluctant. And so, of course, yes, a lot of people have then jumped to the conclusion that the US retail investor isn't embracing it. I see that a bit more of a mixed image. On the gold mining side, we've seen a little bit more interest. Now, if you want to see all this positively, then there's a lot of potential there. If you want to see it negatively, then it means that even with the high gold price we have, if that even doesn't get it going, where's gold going to go from here?
Well, Axel, I'd love to ask you a little bit more about OUNZ, the fund that you do manage, just because in the field of ETFs where people want to get positioned in the metals, I think there's some unique features to it. And in specific, I'd love you to talk about the redemption. And then also, I hear people ask questions like, what if these ETFs can't get the gold? What if there's such a big price move? And you mentioned some interesting comments to us that's really not a worry that you have. So maybe speak to people about the advantages of the OUNZ fund.
Yeah, so OUNZ is OUNZ. That's the ticker symbol for the gold ETF. We launched it in 2014. It's just over 10 years old now. It has about 950 million in assets. And the key differentiating factor is that investors can request delivery of the gold in the trust that they own. It took us 3 years at the time to get that approved by the SEC because we needed to just have processes that were a tad different. We think that they're superior. And obviously, most people don't want to have delivery of the London bars that we hold in London. We provide a tax-free exchange into coins and other bars. Obviously, there's a premium that's payable to reflect that. But it is something that's not just a theoretical feature. People do take delivery once in a while. The key thing about it is that it has the optionality of taking delivery. And as a result of that, we tend to attract a more long-term investor. And as we just discussed, investors tend to be more on the physical side right now. And our fund in that sense is in the middle because we hold the physical gold with the ultimate proof in the sense that you can take delivery of it. We tend to have been more favored in this industry. We have a few other differentiating features, but I think that is the key one. To your other question, what if there is no gold? Well, the way that these gold ETFs work, and notably ours as well, is that when shares are created, we don't go out and procure gold. It actually happens the other way around. In exchange traded products, you have so-called authorized participants that can engage directly with the fund. Now, for physical gold, there are not as many that do this because you need to know how to work with physical gold. But basically, the authorized participant has to deliver gold to the custodian. The custodian needs to allocate the gold. And in our fund, at least, only once the custodian has indicated or certified that they have allocated the gold, then shares are issued. And so basically, in that scenario that, oh my God, there's no gold available, well, from a ETF point of view, we don't really care because we don't worry about a shortage. What we care about is that if people want to have new shares, they need to give us the gold. And so we don't, quote unquote, care where they get it from. But what we care about is that it is delivered and allocated. That's what we care about. And so these sort of risks, so to speak, are being externalized.
Axel, you mentioned that fund or that ETF attracts the longer term investor. Have you noticed a different sort of investor, a new investor coming into the market, or is it still the same type of investors, the same investors that you've seen in the past?
Well, in general, we see, I look at gold investors from several different points of view. I'm looking at the investor worried about the long-term purchasing power of the dollar. I'm looking at the investor interested in diversification, and I'm looking at the investor who is the speculator. Now, we have never attracted the speculator in OUNZ, but we do see a mix of the long-term investor versus just the asset allocator. And yes, we have seen advisors, asset allocators allocate more money to OUNZ. And that's partially a reflection of size. We're just under $1 billion now, when the fund was much smaller. The bigger advisors, even though it doesn't really make much of a difference from an ETF point of view, but they tend to be more reluctant to allocate to smaller ones. And also in recent months, we've had advisors allocate. So there is professional money, so to speak, being allocated, not just retail money. Beyond that, there is a steady stream. We happen to think that the retail investor is actually quite sophisticated in how they allocate money. We've been serving retail investors in public products since 2005, and while they often get a bad name with some so-called experts, we have observed them long enough to be of the opinion that a lot of retail investors are actually quite sophisticated in how they allocate money.
Well, Axel, because you have been in the sector for decades and you talk to so many different types of customers and end users and investors, what is your take on the recent rise in not just gold to break out to new all-time highs, but also silver finally breaking up above 30, which is something people have been waiting for really since 2013, so over a decade, and then copper finally breaking out to a new all-time high just recently? It seems like there is more of an interest, even from generalists, in the metals and in the commodity sector. What sense do you have of how generalists are viewing the sector?
Yes, and just the broad point first, there's been, of course, a lot of attention to strategic minerals, and in that sense, gold has been less exciting. Some digital assets are more exciting to some types of investors, and for better or worse, we have never attracted that sort of investor that's investing for the fear of missing out and the like. But to your question, the broader commodity sector has, of course, been doing quite well. Just as a caution, it is a very volatile space, has always been. So unique aspects in the copper space in particular that might lead to some shortages and whatnot. But as you point out, yes, silver finally broke out. Silver, I think, is the one investment that's frustrating investors very often. Silver is somewhat related to gold, but the key difference is, of course, that there is much more industrial use in silver. And so whereas gold tends to be a very pure reflection of monetary policy, and the mere easing bias helps. If you really have a down economy, it's possible that industrial production globally is suffering, and through that, the demand for silver might suffer. And because maybe we've had this environment where this economy hasn't faltered, silver has really been able to shine, no pun intended here, because we have not had this substantial economic slowdown that would then affect the industrial demand negatively. And quite the opposite. We have a lot of governments being very activist on their investment schemes, public infrastructure schemes and whatnot. And commodities tend to benefit from that.
Axel, we've also heard a lot of China, the Chinese citizens buying gold, and also rumors that they're now buying silver, and that's helped push the silver price up. You have any insights on this?
Well, only the broader point that it's not that the Chinese are gold bugs. It's the Chinese investors don't have good investment choices. They don't have well-developed capital markets. And so they tend to go into very few investments. And then historically, they've often gotten burned. Take real estate, right? Being the one investment where that can lead to riches. And then these various investment products are offered by some institutions in China that haven't worked so well. And so an increasing number of Chinese have realized, well, if none of that works, maybe we invest in gold. And that's, of course, that can easily take on these aspects of speculators that can drive the price up unsustainably. That's why I never like it when the speculators jump on too much. Now, in China, of course, you don't just have the retail investor, you also have the government buying more of gold. And these trends can last a long time. It is something that I'd like to watch. And if there's any reason why it should reverse, then that is noteworthy. In the meantime, if on long term wants the Chinese to invest more broadly, the Chinese government needs to provide a friendly investment climate. And I don't think that's happening anytime soon.
Well, Axel, just thinking about China and the global stage, there is a lot of interest in copper as well as silver for industrial applications. But there's also this whole narrative now running in the West about data centers and AI and how we're going to need a lot more copper to be able to do all the electronic transmission of all the power, but also we're going to need a lot more power. So silver plays into solar panels, and then obviously it's spiking things like nat gas and uranium about power. Do you see that being part of the story here with copper and silver, in addition to just this general rise in commodities?
Oh, it definitely is, with the caveat that these are very cyclical industries. There are some production outages or getting new supply online can in the short term influence these things. But long term, yes, we will need more raw materials of just about everything. I mentioned strategic minerals, but copper, obviously a key ingredient to that. Just back on China, one more point that I missed to make is that the way that the Chinese are trying to bail out their housing sector is completely misguided in my view. In 2008, I very much was a critic of what happened, but at least the the US government gave the right bang for the buck and putting the money into the banks to have the leverage effect that you get from being putting the money in the bank. And just having people buy up housing units is an utterly inefficient way of doing it. And that's super inefficient. And the reason I mentioned in the gold context is, of course, that tends to be then if the government can just print the money to do it, that can also be inflationary. Now, we have a very controlled economy, so maybe inflation doesn't show up the way you would otherwise think that it might, but it is quite likely one of the reasons why the Chinese like buying gold, because they don't trust the government with the money.
Yeah, fair enough. We've seen actually quite a bit of demand too out of central banks over the last almost 10 years now, I think it is, for gold. It's definitely helped hold the price up there. Real quick, Axel, what about copper? Copper broke out above $5, pretty quickly reversed, but is still generally at a high price, and let's say, well, above 450 right now. In terms of the copper moves, what has your attention? What do you think is sustainable?
Yes, I said about as much as I want to on copper without going into. I don't want to give a price target for copper, in part because it is so notoriously volatile. The only thing I can observe, it's been stunning how much it has risen. And yes, medium term, there is going to be substantial demand in copper. I still remember I installed some solar panels during the pandemic, and I didn't like the price quote. I'd say I buy the copper myself, and the panels are about 200 feet away from where the circuit breakers are and everything. And we spent a fortune just on the copper cable. So I think I single-handedly moved the copper price on the markets here on my own little investment that I had there. But yes, copper is not cheap. And again, just the one caveat is be careful when we have these high rise spikes. Don't invest in these markets unless you really know what you're doing.
Well, Axel, I'd like to thank you for individually moving the copper market with your contribution, but I do want to look at who is really benefiting from these higher copper prices and silver prices and gold prices, and that is some of the producing entities, the companies that are pulling the metals out of the ground. This is definitely spiking their margins for the gold, silver, and copper companies, and we've seen some movement in the producers, not as much on the junior side, but what's your lay of the land as far as some of the mining companies and the backdrop they have now with higher metals prices?
Well, the comment I like to make in the context of being a gold manager is that the large producers, they are so large that, and we've been, I think on this program, right, we've talked about how they haven't invested enough in new ounces. And so what they have increasingly been doing is getting copper gold assets, where there is a lot of copper as well. So they're no longer pure plays, or they're beginning to not be pure plays anymore, simply because the copper sites are just much larger. And so they have such deep pockets that they need to invest in these sort of projects. Whereas if they were just to buy individual pure gold projects, they couldn't deploy all the resources. And so it's changing the fabric or the dynamics of the larger gold mining companies somewhat. We tend to focus more on the junior mining sector, so we don't have that, except, of course, the implication is that the larger companies are less inclined to buy these small ones because they're just simply too small for the big guys.
Axel, what about the kind of revaluation that we have seen within the sector? Gold stocks, silver stocks, copper stocks, outside of some of the smallest juniors, most everything has revalued. Broadly, even doubled off of some lows of just 3 months ago. But you pull the chart back to a 4-year chart, and these stocks are still at very depressed prices, considering where they were in 2020, let's say. What do you take from the revaluation of the equities broadly?
Well, the way I look at it, especially in a junior space, they are somewhat credit plays as well. And that's because these junior mining companies need periodic access to the markets to develop the projects they're working on. And so until I put it at last October, when Fed Chair Powell gave what I call a mission accomplished speech, we had a higher for longer environment. The idea of that was to have tight financial conditions. That was a headwind to these junior mining companies. And then ever since then, we've had an easing bias. And that change in bias, even though many of the gold mining companies have still had difficulty accessing money, but that has warranted a repricing. And that is to a significant extent responsible for the move higher in the price of gold, although we haven't had any rate cut yet, right? And so the markets are forward looking. Obviously, if we had a weaker economy with more pronounced cuts being priced in, that might give them a further boost. But I think that is a lot of what's in there. Now, the other thing, of course, is that we had a higher inflation environment. And while some people say, hey, the gold miners are leverage play to the price of gold, it was, of course, not just the price of gold that went higher. It was notably also energy costs that went higher. And on the producer side, energy is a huge cost factor. During the pandemic, of course, getting supplies was super expensive. So the good news is that the costs are pretty much under control in most of these mining companies now. They have moved higher. For the producers, it should give excellent earnings in the coming quarters, assuming the price stays up here. And for that, these stocks are still lower than historically. I'm trying to avoid the word cheap because I can't give investment advice here on any of them. But clearly there's a lot of catching up to do if the valuation should be somewhat consistent with more historic valuations.
Yeah, Axel, to that point where you see costs now starting to moderate, so their input costs aren't as much, the fuel, the labor, and the supplies, whether it's chemical reagents or explosives or even buying equipment, the costs have moderated a little bit, so that's helping on the inflation side, while the prices have spiked, increasing their margins. Do you think that'll create a larger wave of merger and acquisitions? Because to your point earlier, some of the juniors are too small, but we have seen an uptick in M&A activity this year compared to the prior 2 years. Are you expecting to see more consolidation in the space?
Yes, I think it all but has to come. And if the big guys don't buy the smaller ones, the middle guys will merge. There will be more activity. And yes, we have seen an uptick. Right? There will be more. But there's a lot of discipline in that sector. And to me, that means is that we're not at the end of the cycle. Right? Once the discipline gets thrown out the door, then you want to be careful.
So I want to circle back around to something you said there, Axel, and that's historic valuations. If we look at where GDX is priced compared to, let's say, the S&P broadly, or even gold compared to the S&P, we want to go back 10, 20 years. Well, GDX wasn't around 20 years ago, but when it did come out, yes, valuations for gold stocks much higher compared to the underlying equity markets. But now we've been in over a decade of these valuations staying within broad ranges, fairly tight ranges, actually. I have a GDX to S&P chart here. How do you go about analyzing historic valuations, but also understanding that markets do change? So what is the balance?
So GDX was launched 18 years ago, May 22nd, 2006. I just live fact checking here. You are right. It has not been around for 20 years.
Close. It's getting there.
Exactly. No, because we feel like it's been around with us forever. And by the way, GDXJ is not a very junior ETF. It is more junior than GDX is, but you can go far further down. The challenge with GTFs generally is that they cannot help in the fundraising rounds, right? They can only invest in the liquid markets as there is, but they at least the ones that exist don't engage in the sort of any deals, so to speak. But yes, I mean, these valuations are depressed. It's partially a symptom of the times on the other end of the spectrum that anything with AI is super highly valued. And it's ultimately in the eyes of the investor, right? I just recently had a discussion again that said, I'm going to put more money into NVIDIA and take it out of some global stocks because global stocks have underperformed. I'm not giving investment advice here, but it's a symptom of the time, right? That people want to chase the winners, and that's been profitable. And so I'm not telling people that they shouldn't do it. And what I encourage people is that they have a plan of how an investment process and how they allocate it. If their process is to be a trend follower and that works for them, I'm not going to stop them. But what's not good is to just jump on the latest thing that they hear any expert pronounce.
Well, Axel, to that very point, if you think back 18 years ago to when GDX was launched, we didn't have cryptos. We didn't have meme stocks. We didn't have an AI stock craze. There wasn't an NVIDIA juggernaut or the Magnificent Seven sucking up most of the investing capital. There weren't cryptos and crypto miners. I mean, it's a little bit different landscape now. Do you think all those other sectors that have rewarded investors or the volatility in them has at least given traders some options to buy low and sell high? Is that stealing the thunder from this sector that used to get more of the speculative funds?
I have a far more cynical view of all that. I think the reason we have a lot of this is because of the mess that our regulators, legislators, and notably also the Federal Reserve have created. They have rigged the game, so to speak, with zero interest rate policies. When you in 2008 predicted things, you still probably lost money because the rules were changed along the way. Active managers have been priced out of this market, so run out of business because the only thing you need to do is buy stocks and then retire type of thing. And so now are we entering a more normal environment and where maybe we can go back to some sort of sanity? I like to remind people that just a little over a year ago, the Federal Reserve threw a lifeline to the regional banks that completely mismanaged their interest rate risk and invested too much in commercial real estate. And guess what? The result is that the markets are so messed up that when the Federal Reserve hikes rates, it doesn't have as much of a market impact because people locked into incredibly low rates, and these other distortions and safety nets are creating things. And so how that all plays out, I'm not so sure. The one thing though, which we haven't touched on, and don't want to be too political, but people get upset over these things, and populist leaders have a higher chance of being elected. And I think we see that in the polarization we see in politics on both of the left and the right. So to me, that's all part of the same scheme. And I don't see that going away. And I think it was Paul Volcker who argued that in order to have a stable government, you need stable prices, you need good governance, and you need sustainable deficits. That was the third one. And so over the last 20 years, all three of these areas have been deteriorating. Now, all these are still better in the US than many other countries are, but that breeds populism, that breeds, and just take the Dodd-Frank and other regulatory decisions that have been made since the financial crisis, and we live them as a financial institutions that I run every day. They never fix the problem. They just make things more convoluted and create perverse incentives. And that in that process, digital assets, meme stocks, and other things rise are not too surprising to me. Now, does that mean one should lose sight of what gold and gold miners can do? I don't think so. To me, the one quote unquote good thing is that some of the speculators are more on the meme stock side, which means they don't disrupt the stocks as much in other areas. So you can actually make more fundamental investment decisions. But yes, if an area of the market is neglected, that can also look a little lonely for a little bit at times.
So does that mean we need a market revaluation, a market crash in a sense, to rebalance how investors even view gold? Because until then, they're going to continue to be distracted?
Yes, except of course, if that were to happen, we'd probably have the fire hoses come out and the Federal Reserve is going to do something. But yes, if we had real fear in the market for whatever reason, be that because of a dislocation in a subset of the market, or be that a serious concern about a deeper recession, I think what they have in common is that they would get the Federal Reserve to have a stronger easing bias, and the price of gold tends to be most sensitive to that. One of the things I've argued, I think, including on your program, is that when you have a shallow recession, the market tends to, because of its discounting mechanism, looks through that and stocks can go up anyway. If you have a more severe downturn, that's really when gold miners and the like shine, because they react far more quickly to that. And then in contrast, traditional equities do far more poorly. And so that's the sort of area where they shine. And with this economy holding up, at least so far, I think it's remarkable how well gold and gold miners have held up. And as a long-term investor, I'm a diversifying investor, so to speak, right? I don't invest because I think the end of the world is coming tomorrow, because I have news for folks who believe that there's always a tomorrow. That tomorrow may not look like the way you want it, but there is no button where tomorrow there's the end of the world. There's always a day tomorrow. It's just that society adapts, and different things might be fashionable and different things might be acceptable to society.
Well, Axel, just to that point about looking at tomorrow, a lot of people came into this year expecting tomorrow to look like a big recession that so far hasn't come. Some of the economic data has surprised on the upside, but there is this general sense in the markets that you see when you watch financial media of we're in this Goldilocks zone, or we're not going to have a soft landing, we're going to have no landing, and then the recession has been avoided, and even though the yield curve was inverted, and even though we had all these signals, it looks like we've escaped the pain. When you look at it, though, you've mentioned in the past that you still see the potential for stagflation and still see some potential cracks under the surface. How are you looking at tomorrow?
Well, I look at it in terms of risks. I don't have a crystal ball that's any better than anybody else's, but I look in terms of risks, and then if the risks are significant enough, do I factor them into my portfolio allocation? A year ago, I was in the camp that, yep, we're going to have a recession. But specifically what I said is that I think that we're going to have the worst of the economy just before the election, and that may well impact the outcome of the election. I still believe that we could be just before the election in a low. Not sure whether it's going to be the low, whether it's going to go further down, but I do think we are in a weakening economy, and it's going to be significantly weaker at the time just before the election. Notably, by the way, a big part of the voting bloc that is not on the wealthy spectrum, but on the low income spectrum, they've experienced more inflation. They've had a tougher time with some jobs, and certainly on the purchasing power side of things. And so I think that will make itself known. As far as why, it is most notably because I believe in the consumer. We just had a few companies announce that they're cutting prices, some of the larger retail shops, and that is in part, at least, presumably because the consumer is weakening. But we still have the deficits imply that we have still a significant stimulus in the system. And so I think that's part of the reason why this economy has held up better. All that said, it is the bias at the Fed, I think, that drives a lot of how the markets are acting. And notably, that has helped precious metals as well.
All right, Axel, we'll wrap it up here. Thank you so much for your time. Always a pleasure chatting with you. I will post a link so everyone can find out more about Merk Investments. We'll also be chatting with you in the next couple months. So everyone, thanks for tuning into this weekend show. I hope you all enjoyed the coverage, again, focused on the commodities, metals side of things. And be sure to check out our website, podcast, and YouTube channel, the KE Report, for all of our daily commentary and company interviews. Axel, everyone who tuned in, thank you all for joining us. I hope you all have a great rest of your weekend.
My pleasure.
For our upcoming appearance schedule, visit kereport.com. The Corlin Economics Report will be back in just a moment.